Hello everyone, this is CA Harshit Goyal from Value Science Analytics. Today we are going to discuss a new company, Sandur Manganese and Iron Ore Limited. So, Sandur is a flagship company of Karnataka-based Sandur Group, incorporated in 1954. Company is involved in mining of low phosphorus manganese and iron ore in the Ballari region of Karnataka. So company is a 8,800 crore market cap company. So company has three segments basically. One is mining, where they mine iron ore and manganese ore. Other is ferroalloys, and the third is coke and energy. So from its root in mining into venturing into ferroalloys and power generation and adding coke and energy production, company has gracefully navigated various stages of business evolution. The ambitious transformation reflects the company's determination to evolve from a pure play merchant miner into an integrated company commodity player focused on producing value added end products. Sandur has two mining leases encompassing on an area of 1999 hectares, both valid until 31st December 2033. These lease house estimate reserves of approximately 17 million metric ton of manganese ore and 105 million metric ton of iron ore. So here is an idea of how the capacity of the company is. So company has 0.46 MTPA of manganese ore capacity, 3.81 MTPA of iron ore mining capacity per year, 0.5 MTPA of coke, 32 megawatt WHRV based power plant, and 42.9 megawatt solar wind renewable energy. The ferroalloy capacity is 95,000 and 125,000 ton per annum of silicon manganese and ferromanganese. Now let's look at the individual sectors of the company. The iron ore, the company possesses a substantial estimate iron ore reserve of 105 MT, laying a solid foundation for its future mining ventures and reaffirming its position as a reliable and robust iron ore player in the market. So recently, company received an environmental clearance for expanding its iron ore production from 1.6 MTPA to 4.5 MTPA, along with 7 MTPA beneficiation plant and a downhill conveyor system on 25th April 2023. Company received it last year. In manganese, the company holds a distinction of being the third largest manganese ore miner in India. Renowned for its low phosphorus content, Sandur's low-grade manganese ore is well regarded as one of the finest in the metallurgical domain. This exceptional ore plays a crucial role in blends for producing ferroalloys and steel, accentuating its value in the market. In 2018, company embarked on an ambitious coke oven expansion project, which was successfully commissioned in FY21. The subsequent FY22 witnessed the first full year of operations for this transformation endeavor. Presently, company has 4 coke oven batteries with a collective capacity of 0.5 MTPA. Additional 2 state-of-the-art waste heat recovery boilers were strategically established, cumulatively generating 32 megawatt of cleaner energy as a byproduct, which further helps the operations of ferroalloy units. In the ferroalloys units, the primary focus centers on the production of silicon manganese and ferromanganese. The company envisioning the addition of new products in the progressive trajectory. Acknowledging the power-intensive nature of ferroalloy operations, Sandur boasts a 32 megawatt power plant supplemented by waste heat recovery boilers, enabling the generation of clean energy at minimal cost. Furthermore, taking into account the growing energy needs, the company has recently commissioned 42.9 megawatt hybrid renewable energy plant to further its energy self-sufficiency and grow its ferroalloy operations. The solar plant, hybrid solar and wind energy, was commissioned on 13 June 2023 last year. Now let's look at the financials of the company. So this is the profit and loss for the past 10 years of the company. Company's profitability and sales peaked in March 22, the sale of around 2,200 crores and PAT of 675 crores. In the recent concluded FY24, Company has a sales of 1252 crores and PAT of 238 crores, giving EPS of 15 rupees per share. Now let's look at the segment data of this P&L. As you can see, the iron ore sales have increased consistently in the past 3-4 years, and they are at the highest right now, 900 crore rupees. And the EBITDA from mining from iron ore and manganese is 379 crore rupees. Coke, energy, and ferroalloy did really good in FY22, where they had substantial amount of EBITDA, but currently they are in loss. So this is the balance sheet of the company. Company has around 970 to 980 crores of cash on its books and 133 crore debt. So net debt-free company. This capex we are seeing here from 300 to 800 crore was the coke oven plant. The company installed in commissioned in FY21. This is the shareholding pattern of the company. Promoters hold 74.22% of the company. Now here we can see that the earnings have deteriorated in the past couple of years substantially. So let's look at the reasons why this has happened. So what happened in 2022 was the government announced the increased export duty on minerals and metal products in May 2022. Coupled with the global commodity pricing scenario at that time, these two factors adversely impacted not only Sandur but the entire industry in the first half of FY23. The coke and energy segment faced some challenges due to volatile exchange rates of coking coal, making it difficult to maintain profitability in this segment throughout the year. Furthermore, the performance of the ferroalloy segment during FY23 was also subdued due to declining realization and a general slowdown in the steel industry after the export duty announcement. So this all happened in FY23 where the earnings substantially decreased compared to FY22. And let's look at the pricing charts also. So here we have a ferromanganese price chart. It went at a high of 117, it's currently around 126. So this is where, see after FY22, how the prices have declined. This chart gives you an idea of how much the price decline has been, how severe it has been. And this is again silicon manganese price chart. Went up made a high of around 180 and now it's around 110. In the similar way, this is the iron ore price chart. Iron ore also went above 180 and now it has recovered in recent times. It went below 100 in FY23. Now it has recovered a bit and it's in the range of 130 to 140 range. So this has been the key reason, the decline in commodity prices and the government regulation has been the key reason for decline in earnings of the company in FY23 and FY24 after that. Here also, this is a presentation by the company, recent presentation by the company. Here also we can see like earlier 72% of the revenue contribution was from mining and 26% was from ferroalloys. This all changed in FY21 when the company commissioned the coke and energy plant. It contributed 75% in FY21 and in FY22, the first full year of operations, it contributed 43% of the sales and 28% of the PBT. This was also high in FY23, 50% from the sales. In FY24, it only contributed 17% to the sales. This sheet gives you an idea about the iron ore mining operations of the company. So here you can see the iron ore production and sales data for the past 5 years. Earlier, the production cap was 1.6 MTPA for the company iron ore, which has increased to 3.8 now. So FY25 company will see substantial increase in iron ore mining production. And this here is the manganese ore mining operation data. Company has been consistently selling around 0.2 metric ton per annum So company has recently enhanced its manganese iron ore production from 0.28 MTPA to 0.46 MTPA and further proposes to increase it to 0.5 MTPA. Similarly, the iron ore production capacity has been enhanced from 1.6 MTPA to 3.81 MTPA and further proposed to increase from 4.36 MTPA. This sheet gives you an idea of the ferroalloys segment of the company. As we can see, the production has declined substantially from FY22 from 54,000 ton per annum to 28,000 ton per annum. This is also due to the coke plant not running at the full capacity in FY24. So it's a very high power intensive operation ferroalloys. Without the efficient coke plant, the capacity is also suffered in ferroalloy segment also. The production was 20,000 in FY20, peaked at 55,000 in FY22, and now it was 28,000 in FY24. There is a coke energy capacity and complete profile of the company. Now, one very interesting recent development which happened in April 2024 was that the company has made a strategic business acquisition of Arjas Steel Private Limited. So the company is acquiring the plant at 3,000 crore EV enterprise value. Around 80% of the equity will be taken by the Sandur in the company and 20% in personal capacity. So it will take around 7 months, subject to all the clearances, when it will be on the books of the company. So it's a very good steel company which they have acquired. In FY23, their sales was around 2,800 crore rupees. And look at the list of the clients they serve. Hyundai, Mahindra, Force Motor, Maruti, all good names in the auto segment. In two-wheelers also, in commercial vehicles. So this company produces specialty steel focused on high-quality, auto-grade, special bar quality steel. Integrated manufacturer from coke, sinter, hot metal, and billets to value-added bars and bright bars. Manufactures over 100 plus grades with varied applications and among the top 5 players in the very specialized industry. New acquisition of the steel plant is only 250 kilometers from the mines of the company. So it's a very strategic, it will save a lot in the terms of transportation cost for the company. This was the whole business model of the company, what company does, and let's look at some of the positives of the Sandur Manganese and Iron Ore Limited. The company is focused on expanding asset-light and high ROCE mining operations. They have doubled their capacity in iron ore production and also doubled capacity in manganese ore. Company has built downstream facilities for mining operations. They run cost-efficient operations, resulting in high operating margins and significant operating leverage. They have been generating consistent cash flows to invest further in other segments. They are forward integrating into value-added end products. The steel plant acquisition will give significant boost to their sales and earnings in FY25 and beyond. So the steel plant capacity is 5 lakh ton per annum, and they can further expand it to 1 million ton per annum. FY23 consolidated sales was 2,876 crore of the new steel plant that they have. So it's a pure cash consideration which will be paid by Sandur. So of the 3,000 crore rupees, 2,400 crore rupees will be paid by Sandur. And they already have 900 crore rupees cash on the balance sheet, and they will earn additional like 5 to 600 crore in the next 6-7 months. So they will not have to borrow much for this acquisition. Company has very strong balance sheet. Company is net debt free and has surplus cash and investment next to 970 crores. Most of this extra cash it earns in FY25 will be used for the new acquisition without hampering the balance sheet much. So, post quarter 4 FY24 results, manganese ore realizations have witnessed a significant increase, as evident across the industry. Company has a long track record and extensive mining lease license, which gives company revenue visibility for foreseeable future. New management hire. Anand Sen, the new addition to their esteemed board of directors, with nearly 4 decades of extensive experience in the steel industry at Tata Steel and as former managing director of Tata International, coupled with his past affiliation with nearly a dozen Tata companies, his insights will prove invaluable to the company, especially in context of the recent acquisition. So here are some of the risks for the company. Price volatility. The volatility in coking coal prices continue to pose a significant challenge in this segment. Sandur's primary focus remains on mitigating inventory losses due to fluctuating coking coal prices, followed by the production of coke for energy generation. Lower power generation. The ferroalloy business faced a slowdown in FY24 primarily due to lower product realizations and challenges in energy generation stemming from reduced coke volumes. While recent improvements in realization post-quarter closures are promising, the constraint of lower power generation will persist until coke volumes recover. Regulatory risk associated with the mining industry. Mining industry in India is highly regulated by various state and central government agencies. Production, sale, expansion, environmental clearances, and extension renewal license are governed by various regulations and policies by these agencies. Any unfavorable change in any of these regulations may have an adverse impact on the business profile of the company. However, Sandur is classified as a Category A mining company and it has 7 decades of track record of regulatory compliance and absence of any material operational disruption due to environmental, societal, or company-specific regulatory issues. The mines are also rated 5-star by the Indian Bureau of Mines, Government of India under its Sustainable Development Framework. While exposure to regulatory risk will remain a key monitorable, the scientific and systematic mining process followed by the company in adherence to existing rules and regulations partially mitigates this risk. Susceptibility to inherent cyclicality in the steel sector. Sandur has significant exposure to the steel sector since the majority of its product find application in the steel industry, which is an inherently cyclical industry. Also, Sandur has recently acquired a steel company in April 24, which will contribute meaningfully to its revenue going forward. Coming to the valuations of the company. So, company has cash surplus of around 850 crore rupees, net cash surplus. This gives a company enterprise value of 7,900 crores and is available at EV of EBITDA of 24 times, market cap to sales of 7 times, and price to earnings ratio of 36 times, based on FY24 numbers. Growth in sales and PAT has been negative in the past 2 years due to substantial correction in prices of iron ore and coke. Company has produced 1.97 MTPA iron ore and sold 1.6 MTPA of it in FY24. Now, this capacity is 3.8 MTPA in FY25. So, iron ore sales are set to double in FY25. Now, if we look here, like, just look at the segment data. So, company has made total EBITDA of 320 crores. Out of this, 380 crores has come from mining operations, and coke and ferroalloy were in loss. So, now this sales of 910 crore of iron ore is set to double in FY25, more than double. So, as per our estimate, this can give additional at the current prevailing prices of iron ore. This can give an additional 380 to 390 crore of EBITDA to the company FY25. Also, additional sales of 3,000 crore per annum is set to come from the steel plant. Now, steel plant will only be available for 5 to 6 months in FY25, and in FY26 it will be fully available. Manganese ore, which was 0.2 MTPA in FY24 is set to more than double in FY25. And also, the prices of manganese ore are in good uptrend, which will further boost the EBITDA. Considering all these three factors, we will not be surprised if EBITDA is in rupees 900 to 1000 crore rupees range in FY25. This gives a valuation of less than 8 times of EV by EBITDA based on FY25 numbers, which is quite reasonable considering the upcoming growth. And this is a very conservative estimate we are taking. So considering these three factors, like doubling of iron ore capacity from 1.9 MTPA in FY24 to 3.8 in FY25, doubling of manganese ore capacity and the current price trend in manganese prices, and the acquisition of new steel plant, companies available at very reasonable valuations comparatively to its peers also. Thank you.